Welcome back to part 2 of the 10 most critical aspects to understand in trading. Let's talk about laddering profit targets. So like the previous concepts, this one's still pretty straightforward. Again, one of the main reasons that traders struggle is not because the concepts are overly complicated. It's mainly sticking to the rules. So how does laddering profit targets work? Like I stated in the last video, the key to trading is to cutting losers quickly and letting winners run. So let's look at a short trade example here. Say that we've entered a short trade, and now we want to divide up our profit target. So how do we do this? Our first profit target should be the bulk profit target. A general number you could use is about 40% of the position. So by the time the short trade hits around here, we'll have locked in 40%. The next one is about 20%. And these numbers are interchangeable depending on what fits your style. But the first one should generally be a bulk profit target. And by the time we hit our bulk profit target, we should move our stop loss into profit. Or at least at break even. Maybe a little bit into profit to cover the fees and commissions, but break even is fine. So we've secured 40%, our stop loss is now in profit. Sometimes you're going to get stopped out. Sometimes you'll run to your second profit target. So now you've locked in 60% in profit. And the third one I like to do is also 20%. Okay, so same thing, 20% if the market ends up giving it to you. And then you might be asking yourself, well, wait a minute, these three numbers only add up to 80%, so where's the last 20%? The last 20% is going to be our runner. So this is taking advantage of a trade that ends up turning out to be a lot more. And the way we do this is this last 20% is only closed via the stop loss and profit. So let's say that the market has really followed our methodology, and we assumed that the market was going to correct pretty hard, and that's what happened. We can bleed our stop loss into profit further and further and further as the market continues to go in our favor. So the average risk reward will be calculated between where these profit targets were taken and eventually where the 20% runner will be taken. And if you're scalping, then this could actually keep going and going and going on the high time frame, and you can get more money out of this 20% in some scenarios than you would out of the 80% that you closed. But at least we're allowing ourselves to let our winners run, because we know we're not always going to have winning trades. We know that a good portion of the time, particularly if we're going for this much risk reward, a good portion of the time is we're going to get stopped out on these trades. So I want to make sure that when we do have winners, that they end up paying for all the losers and then some. Now, you can also do this with stop losses as well. I talked about in the last video how I was going to explain how to avoid slippage in other fancy ways. Simple way you could do that is, say you want your stop loss here. You could start some of your stop losses there and sort of stagger them out. So you have multiple stop losses for the same position. So let's say you were doing 1% risk on the position. You could have 4 stop losses that are all 0.25% risk each. So each one of these ladders is 0.25%, and they're spread out, but they would still equal the same 1% risk. So that's a way you can sort of negate slippage. It's very popular to do, and so most people refer to areas on a chart as a zone instead of a level. It's because at the highest levels, when dealing with slippage, you have to spread your positions out in order to exit where you want to, in order to not end up taking or incurring that slippage. You can also do it for entries as well, although you don't need to. It really depends on your position size. If you have a smaller account, you don't really have to worry about spreading your entries or spreading your stop losses. The profit targets, you should still do that. But for bigger accounts, that's where you can start to spread your entries and your stop losses in order to make sure that there's enough liquidity to get in and out of positions when you want to and at the prices that you want to. Risk reward. This goes back to cutting your losers quickly and letting your winners run. Generally speaking, you want to have, I guess if you're new, you want to have 2 to 3 risk reward minimum. The higher the risk reward generally is better, but what's the outcome of having high risk reward? Well, if you have very high risk reward, like in this example, it's around 6. Most of the time that trade is going to get stopped out, and most of the time it's not going to go to your profit target. But when it does, like in this instance, it would pay for all the previous stop outs in the past. The biggest issue with this is, you know, traders don't like to lose, humans don't like to lose in general. So losing a bunch of times in a row can lead to risking way more on the next trade than you would normally do, which obviously can be an issue, particularly if that trade also doesn't work, and it can do a lot of damage to your account. So if you want to have your win rate a little bit higher because you're not comfortable with this idea of losing money, then you can go to like the 2 to 3 risk reward and still be fine. At 3 risk reward, you're still generally going to have more losing trades than winning trades, but it won't be as extreme as if you're going for, say, 10 risk reward. And as far as, you know, how much risk reward is the perfect amount, it really depends on what the market gives us. Sometimes the market will give us a really nice trade with high risk reward, sometimes it won't, and that's okay. So we want to be able to sort of mold ourselves to the market and adapt to what the market's giving us. And as long as the risk reward's above 2, you can argue that the trade is still good. But anything below that, you know, you're not really cutting your losses as quickly as you're letting your winners run, which can be an issue because there's a huge burden of win rate, meaning you must win the majority of your trades in those scenarios. And if you don't, obviously you're not going to be profitable. And then also the fees and commissions that you're going to have to pay by going that route as well can be quite gnarly. So the better approach is just to make sure your risk reward is around 2 at the very minimum, particularly if you're new, but really want to get closer to 3 or 4 as the minimum. Okay, understanding structure. I'm not going to be able to explain everything about structure in this video because it's, you know, there's a lot to it. But some basic things and some other videos on the channel that I've talked about is just where you want to find the pain point at. So if we're looking at a chart, and this is a pretty common example I talk about a lot, but just for instance, if we're looking at a chart, the price is going up, the price returns to the low, it bounces off of it, it's going up, it makes a lower high, it bounces off the low, makes another lower high, bounces off the low. So the interpretation for this would be, okay, well, support is really strong, right? Because every time the market has come down to test it, it's been respected. But the question you have to ask yourself is, if this support was so strong, why did we fail to make a new high higher than this high on the first move up? Why couldn't the price do a lot more if it was so strong? And then again, why couldn't the price at least get higher than this high on the next way up? So while it does look like the price is, or at least the support is strong, or the price is respecting the support, the reality of the situation is we have to look at both sides. What's happening on the top side relative to the bottom side? And the other thing that we can understand from this is, and this is regardless of financial instrument for the most part, has to do with the psychology of the crowd. If everybody views this as support, then we know that stop losses, liquidations, mental invalidations are all resting in the same area. So that means some market participants can be very bullish and exuberant and thinking, oh, the price is going to go up because we've bounced off it so many times. And those same market participants will be like, well, what happened here? Why did the price go lower? Uh-oh, that's bad news. I better sell. And so everybody's selling at the same time. And this can lead to a lot of liquidity in this area. The opportunities for this would be looking to short it at these lower highs, depending on the context of the structure. But again, I can't go completely into detail on that in one YouTube video. But another opportunity that's pretty simple is if the price reverses from here. Because if everybody's selling at the same time, then the price should be falling a lot relative to the movement that it's had in the past. But if that's not the case, and the price only falls a little bit, and sometimes if we see a spike in volume right here, and we see a reversal, then could be an opportunity to go long. There's other market structures too, like the inverse of this. And there's other ways to read this kind of stuff. If you have, and this is kind of in a perfect scenario, it doesn't occur too much, but if you have like equal highs and equal lows, so sort of the same thing on both sides where you have a clear resistance and a clear support, then you could wait for either one, meaning you could wait for it to break out to the top, and then if it doesn't go a lot higher, because you'd be assuming a lot of short sells are going to be closing at the same time, which operate at market buys, or just psychology would be buying the breakout. And then that fails, then you have a short position to go to the other side. Same thing, if that fails, then you have a long position. And so now you have your short position and your long position, and price is sitting here. And you're good, right? Because both of them are in profit, likely stop losses are in profit. So the next thing you want is just a big move to one side or the other. Another thing is consolidation. So let's say, it doesn't really matter if the price was going up before this happened or the price was going down, but let's just assume the price was going up. If you have sort of these lower highs and higher lows, and they're not really equal to each other, but they're all just kind of narrowing in, it means that new trades that are being opened, and even previous trades, will start to squeeze an invalidation. So these lines I'm drawing are to visualize the stop losses. So all the stop losses from here and all these previous highs and lows will start to converge into the same area via trailing stop losses or people manually moving their stop losses closer. And so we have this point in time consolidation where there's not much volatility, but what that leads to is a bunch of market participants stacking invalidations on both sides of the market. A lot of the time this leads to big volatility and a move that has a trend to it. So simple hedging strategies here can be very effective. If you do have a bias though, you can take advantage of the fact that there's going to likely be volatility in the future, and when there is, it'll likely have legs to it, or there'll be a trend. Understanding high time frame for context, which is the next one. And again, I'm not gonna be able to go through everything when it comes to structure. There's a lot of different scenarios that you see on the market, but these are just some basic ones that pop up pretty often. Using high time frame for context, there's a video on the channel where I talk about how to do this, and I was looking at the silver chart. But to keep it simple, you want to use what's happened on the daily chart and the 4-hour chart. And by the way, I think the 4 hour is really the sweet spot, but the daily is important too, to be able to help you navigate how to trade on, say, the 15-minute, or if you're really good, scalping on the 3-minute. So using these two time frames to help you understand trend and direction, so that you know whether you should be longing or shorting on the lower time frames, is paramount. It is possible to scalp on the 3-minute and 15-minute without using the higher time frame trends to help, but it is way, way easier when you understand where the bigger trend is likely to go. Let's say the bigger trend is likely that the market will go down. Well, then you know that if you're scalping on the 3-minute or the 15-minute, you should be looking for short sells more than longs. Not only that, but there's a lot of random noise on the lower time frame, like the 3-minute's fairly random. If you know the bias, like I said, the market is likely to go down on the 4-hour or the daily. When we reach certain highs, the randomness will be less. So it'll be more probabilistic, less random at the highs, where the lows could get like really messy and choppy and stuff. Really hard to grab a long, whereas like the shorts will be really clean to grab on the lower time frame, which is important. So yeah, there's another video on the channel where I go in detail about how to do that with actual candlesticks, and it's a chart on silver, but it's applicable to almost any financial instrument you could trade. And then relative strength. You could use the tool, which you're probably familiar with, called Relative Strength Index, but you don't need that tool. Basically, let's say price is going up, and then price goes up, but it wasn't as significant. So to keep it simple, the distance between the first high and the second high is greater than the distance between the second high and the third high. You could interpret this as buyers slowing down, buyers being exhausted, or sellers starting to pick up, however you want to interpret it. But the reality of the situation is, if it was so bullish, if there was so much demand, why couldn't this high be a lot higher? And once we see that start to happen, there's a potential to actually short it. And the same thing could be said on the other side. You know, you're making lows, and then the lows start to become less significant, right? So the distance between this low and this low is much greater than the distance between the second low and the third low. Again, however you want to interpret that. But if the supply was overwhelming the demand by so much, then this should have been able to go a lot deeper. And if that's not the case, then there's potential for a reversal. So anytime you get a new high and a new low, you want to look at the previous highs and the previous lows and see how significant that new high or low was relative to the previous ones. If it's not significant, there's a potential for a reversal. Okay, this was part 2, but that was the end of the 10 most critical aspects to understand in trading. Obviously, it's not that simple. There's still other stuff. And I'll continue to post things on the channel if you want to check it out. Look forward to seeing you guys in the future. Have a good rest of your day.